Good afternoon. My name is Koert Jansen and I'm Fund Manager of the Triodos Sustainable Trade Fund. I'm very pleased to be here since this topic is very much related to the core of what we do with this Sustainable Trade Fund. With Triodos Bank, we have been financing sustainable and fair trade supply chains since almost 15 years now. And building on this experience, we launched last year this particular Sustainable Trade Fund, to which Rob already referred. So we have just had our first anniversary. Later that year, that is 2008, we set up a Millennium Consortium together with 5 partners in order to scale up this typical form of finance and also to mainstream the concept of value chain finance among other banks, especially also in developing countries. So far, a few words of the introduction and a bit of publicity for the work we do. Now, I want to share with you a particular concern that we have as financiers of sustainable trade. And I'm fully aware that this is a technical topic, so I apologize on beforehand for bringing it up, but it is important, so I hope you're willing to stay with me. Value chain financing is about banking against the strength of value chains, more so than banking on the strength of an individual balance sheet. Now, the strength of value chains is tested every year by price developments. You can imagine that if 2 partners are doing business, are trading with each other, are concluding their seasonal contract for 6 till sometimes 12 months, the price development in that period is quite critical. For example, if in that period coffee prices, if we talk about coffee, are spiking, then you will see that farmers will be a little bit reluctant to deliver the coffee. They hope that prices will even increase even further. And this, of course, will put the value chain and the trade contract to the test. This is nothing new. This behavior is of all times and very much understandable. What is new, though, is that the commodity price dynamics have changed quite a bit over the last 5 years. Price dynamics in commodity markets have become distorted by large-scale speculation on the commodity exchanges. Not by traditional speculation, which is very much based on trading using in-depth knowledge about supply and demand fundamentals in a market, but by a new type of speculation, which is referred to as so-called index speculation. Here we go. But I will explain what it is. Since 5 years, commodities have been kind of discovered by institutional investors as a new asset class. You have equity, you have bonds, and now there is commodities. So large institutional investors allocate part of their funds into commodities. And to accommodate for that demand, banks have developed what we call these index funds. Now, what do index funds do? They passively invest in baskets of various, in principle, unrelated commodities, including metals, energy, and several agricultural commodities. And per definition, these funds, when they speculate, invest, they do that not on the basis of in-depth knowledge of supply and demand of the particular commodities. They just buy bundles of commodities, and the amount of money which they invest is very much related to the asset allocation of the underlying investors. Meanwhile, so it has grown rapidly after 5 years, they have become a dominant player on the commodity exchanges. We're talking about literally billions of dollars. Now, the impact of all this, because that is of course the crux, is that price distortion occurs. Over the past 5 years, we have seen this speculator flow driving up the prices of commodities. We all remember past years' food crisis and commodity crisis, spiking food prices. A large part of that can be explained directly by this speculation. Also, volatility increases. And this is all very much understandable, because every commodity contract that is traded for other reasons than of supply and demand is, of course, has a distortive effect in the real economy. I will not go further into this, but for those who are interested, we can refer you to, for example, a person called Michael Masters in the United States, who has been the whistleblower there to put this subject really on the agenda. Today, the commodity exchange supervisor in the US is looking into the possibility of new legislation to kind of put a dam on this type of speculation. I can also point to a study that Triodos Bank has commissioned on speculation in the coffee markets. We brought a couple of these reports with us, and also the author of the study is today with us, Maarten van der Molen. So if you want to speak with him, he is here. And finally, we can also mention the UNCTAD report, the United Nations Conference on Trade and Development, which was released only a month ago. One of its 5 chapters is fully dedicated to the impact of what they refer to the financialization of commodities. Consequences are far-reaching. Many developing countries depend on the export of commodities. You would expect that higher commodity prices based on this speculative behavior is good, but they can actually do harm when they are artificial and strongly volatile. Wrong price signals lead to wrong investment decisions and wrong trading decisions. If you look at Millennium Development Goal number 9, which is about global partnerships, it calls for an open and rule-based, predictable, non-discriminatory trading and financial system. Well, we believe that this speculation is doing quite the contrary. To conclude, I think it would be nice, of course, if we in our sustainable fair trade niche would be sheltered from these brutal forces. Unfortunately, of course, we are not. And I think we as fair trade sector, one of the best things that we can do is to continue demonstrating that the best way to invest in commodities is not on the commodity exchanges, but right on the ground in real stuff that really matters. Thank you.